You have been watching charts for months, maybe years. You have studied candlesticks, you have learned patterns, you have applied indicators, you have followed a structure, and somewhere in all of that, you develop a belief so deeply embedded you have never once questioned it. That the market moves because of what you see on the chart? Momentum, patterns, signal, breakouts. It doesn't. The chart is not the reason price moves. The chart is the evidence of something that was already decided before you opened it. And until you understand what that something is, every pattern you recognize, every setup you identify, every entry you take is built on a foundation you have never actually seen. By the end of this video, you will understand what the market actually is, not what it looks like, not what it produces, what it actually is, and what it is actually trying to do every single second it is open. And once you understand that, the randomness disappears. Not because the market becomes predictable, but because you finally understand what it was always doing while you were trying to predict it. Stay with me. This is not a strategy video. There are no entries in this video, no setups, no patterns, no signals. I spent over a year building strategies on top of a foundation. I had never actually examined every tool I added made the system more complex. None of it made the losses make sense. That is what this video is about. I am going to call this as a perception installation because that is exactly what it is. And I will tell you directly. If you skip this video and go straight to order blocks, fair value gaps or any other concept on this channel, you will memorize the shape without understanding the mechanism. And memorizing shapes without understanding mechanisms is the definition of pattern addiction. This video exists to prevent that. Everything on this channel builds from what I am about to show you. Here is the mental model most traders carry without ever knowing they carry it. More buyers, price goes up. More sellers, price goes down. That sounds logical. It sounds obvious. It sounds like the foundation of everything. It is incomplete. And that incompleteness is costing you every trade you cannot explain. Because here is the reality that model ignores. Every transaction already contains both a buyer and a seller. For every buy, someone sold. For every sell, someone bought. So the question is never who is buying. The real operator question is this: where can large orders actually be filled? That question and everything it implies is what separates retail thinking from operator thinking. Here is the behavioral reality of what happens when a trader carries the incomplete model. They see a breakout, they enter long, the breakout looks clean, momentum confirms, structure supported, then price reverses hard immediately, and the trader sits in silence, staring at the screen, asking the same question every time. What did I miss? The answer is not in the pattern. The answer is in the question you never learned to ask. I remember sitting in front of my tablet, watching a breakout from exactly the way every course told me it would. I entered clean, confident. Price reversed in 4 candles and took everything. I sat there for 20 minutes, not angry, just genuinely confused because I had done everything right. That confusion stayed with me for months, not the loss, the confusion. It was only later, much later, that I understood I had not done everything right. I had done everything visible. And visible and right are not the same thing in this market. Here is the belief that sits underneath every trade you cannot explain. That the market moves because of what appears on the chart. It doesn't. The chart is a record, not a cause. Candlesticks do not move markets. Indicators do not predict markets. Patterns do not cause markets. The market moves because an ongoing auction process is continuously searching for liquidity so that large businesses can be transacted. That single sentence changes everything downstream. And I know how it lands when you first hear it because I heard it and did nothing with it. I felt it as interesting, then I went back to looking for patterns. That is what most traders do with this idea. They hear it, they agree with it, they keep trading exactly the same way. Because understanding it intellectually and feeling it in the moment your setup reverses are completely different things. Retail trader asks, where is price going? Operator asks, where does price need to go to find enough liquidity to facilitate the next large transaction? Same chart, completely different question, completely different outcome. In a moment, I'm going to show you exactly what the market actually is and why price is forced to move the way it moves. But first, you need to understand one thing about liquidity that most traders never fully grasp. Because once you understand this, the breakout that reverts on you, the sweep that took your stop, the move that looked perfect and then failed, will never feel random again, and you will never be able to unsee it. The market is an auction engine, not a prediction machine, not a fairness machine, not a trend machine. An auction engine, its job every second it is open is to continuously match counterparties, facilitate exchanges, seek liquidity, and rebalance inefficiencies. That is all it is doing. That is all it has ever been doing. Now, here is what that means structurally. Imagine an invisible oceans of orders surrounding current price at all times. Above price, stop losses from traders who are short, breakout buy entries from traders expecting continuation, trap shorts waiting to be squeezed, pending buy stops resting above obvious high, below price, stop losses from traders who are long, panic sell entries from traders expecting breakdown, trap long waiting to be liquidated, sell stop resting below obvious lows. These are not abstract positions, they are people sitting in front of screens who entered with a plan and are now holding something that is moving against them. Their discomfort is the liquidity. Their stop orders are the fuel. You have felt this without having language for it. The trade that looked perfect, the entry that made complete sense, the stop placed at what seems like the obvious invalidation point, and then the precise, surgical move that raised your stop and only your stop before reversing in the direction you predicted. That feeling of being specifically targeted is not paranoia. It is your nervous system recognizing a pattern it cannot yet explain. What you felt was real. The explanation you gave, it was wrong. Price moves through these pools, not randomly, not emotionally, functionally. Because large participants need what is sitting in those pools to fill their orders. Retail traders see price approaching resistance and think the market is respecting the level. Operators think the market found enough opposing liquidity there to facilitate large businesses. Massive difference, same chart, different questions. Now here is where the model becomes real. This is the part most trading educations completely skips. Imagine a bank wants to buy 800 million in Euro USD. They cannot click buy and expect that order to fill cleanly. An order of that size entered aggressively into the market, moves price against the position before it is even half filled. Slippage explodes, average entry worsens, executions becomes inefficient. So they cannot simply enter. They need massive liquidity. They need trapped participants. They need emotional participation. They need stop orders being triggered. They need breakout entries being placed. They need panic reactions creating counterparties. They need people who are certain, people who just saw the confirmation, people who finally got the signal they have been waiting for and entered with full size right into the move that was designed to give them exactly that feeling. And this single constraint is the hidden engine behind almost every market behavior you have ever been confused by. Now watch what this looks like on a chart. Price is sitting below a major high. Retail sees resistance, breakout, setup, bullish structure, momentum, compression, the cooling energy before expansion. Above that high, breakout buy orders, short stop losses, FOMO entries waiting to be triggered. That area is a liquidity pool. Now imagine a large institution actually wants to sell. What do they need first? Buyers, so price gets pushed above the high, breakout buyers enter. Short covering begins, FOMO participation floods in. Now there is enough buy side pressure for the institution to sell into. This is why the breakout becomes the reversal. Not always, not every time, but structurally, this is why it happens. The breakout was not a signal, it was an execution mechanism, and you were the liquidity. Now, here is what this means for every chart you have ever looked at, and for every trade you have ever lost on a setup that looked perfect. Stay with me for this. You have been reading the chart. You have never asked what the chart is actually for. The chart is not a prediction tool. The chart is not a pattern library. The chart is not a map of where price will go. The chart is a record of an ongoing auction process searching for liquidity so that large businesses can be transacted efficiently. Every sweep you have ever experienced was liquidity being accessed. Every false breakout was an execution mechanism. Every reversal that surprised you was inventory transfer completing. None of it was random. None of it was personal. None of it was the market attacking you. It was the market doing exactly what it was designed to do, and you were reading the residue of a process that had already finished before you placed your entry. The market is not the mechanism creates the pattern. And that distinction is the line between a retail trader who memorizes shapes and an operator who reads the process those shapes are the evidence of. So what does the market actually looks like when you stop reading patterns and start reading the auction process? Four stages. Every cycle, every time frame. Stage 1. Accumulation. Large interest quietly build inventory. On the chart, this looks like compression, overlapping candles, balanced, two-sided momentum, low emotional energy. Most traders ignore this stage because nothing appears to be happening. The operator studies it carefully because large businesses is occurring invisibly inside the balance. Stage 2. Liquidity generation. Price moves towards obvious levels, equal highs, period lows, emotional breakout points, retail participation increases, stop clusters, breakout traders engage, liquidity concentrates. This is the stage most retail traders misread as signals. The operator reads it as fuel being created for the next stage. Stage 3. Expansion. Once positioned and once liquidity is collected, price expands aggressively. Imbalance appears, inefficiency forms, lead participants chase the move. This is where most retail traders finally enter. At the exact moment, the institutional moves is already funded by the liquidity they just provided. Stage 4. Distribution and rebalancing. Large interest being reducing exposure. Profit taking appears, two-sided trade returns, imbalances get addressed, then the cycle begins again. Every chart you have ever opened is somewhere inside this cycle. The question the operator asks is never where is price going. The question is which stage of this cycle is active right now and what does that stage require before the next one can begin. Three mistakes that prevent this from being installed. Mistake 1. Pattern addiction without context. The trader learns order blocks, break of structure, liquidity sweeps, fair value gaps, then searches for them mechanically. But patterns disconnected from auction context become visual gambling. The operator does not ask, what pattern is this? The operator asks, why did this form? Where is the liquidity? Who is trapped? What stage of this cycle is active? Mistake 2. The conspiracy trap. Only traders understand institutional logic. Many become obsessed with manipulation narratives. They see institutions behind every candle. They believe every move is engineered. They become paranoid. This destroys objectivity. Institutional logic explains recurring behavioral tendencies. It does not explain every movement. Markets are decentralized, probabilistic, adaptive systems. The operator remains humble. Mistake 3. Knowledge without installation. The trader understands this concept intellectually, but under pressure, when the sweep happens, when the breakout reverses, when the stop is taken, the nervous system overrides the knowledge. Panic, urgency, revenge. Understanding this concept is not enough. It must be installed in the nervous system, not just in the mind. Installation happens through observation, not through more concepts. Here is your challenge for the next 48 hours. Do not take a single trade. Open your charts and mark liquidity above obvious highs, liquidity below obvious lows, areas where emotional retail positioning clustered, sweeps that preceded significant moves, and false breakout that reversed aggressively. For each one, write one sentence, not a pattern name, not a setup description. One sentence answering this question: what liquidity was accessed here and who provided it? Do this for 48 hours, 5 charts minimum. By the end of that exercise, the chart will start looking different. Not because the patterns changed, because the question you are asking changed. Price has never moved randomly. It has always moved through an auction process, searching for liquidity, facilitating large businesses under the surface of everything you were taught to see. The patterns were always rare, but the patterns are not the reason. They are the evidence of a process that was already complete before you identified them. Learn to read the process, and the patterns will never confuse you again. If this is the work you are doing, stay on this channel. I only post when there is something worth teaching.